historically at stock market valuations before the 2000 stock market bubble, before Alan Greenspan was there artificially suppressing interest rates and blowing bubble after bubble, with each successive Fed chairman adding more pages to the same playbook, the average PE on stocks was maybe about 15 or 16 times earnings. When stocks went below 10 times earnings, that's when they were cheap. When they rose above 20 times earnings, which they did occasionally, they were expensive. That's where we are now. Now, yes, we did maintain high PEs with 0% interest rates and quantitative easing. But if you're looking at that in the rearview mirror, with the Fed hiking rates and fighting inflation, we should go back to a normal PE. We shouldn't be staying at these absurdly high valuations that were a function of monetary policy that, at least for now, no longer exists. But what's even more important than the historic PE is the fact that the E, earnings, is inflated and is going to come down. U.S. companies are not going to be able to maintain current earnings because those earnings were manufactured in an era of artificially low interest rates. Well, the ability of corporations to manufacture those earnings is gone. And in fact, as corporate debt matures and has to be rolled over at higher and higher rates, that's going to diminish corporate earnings because the interest expense is going to go up. And because so many companies are spending so much money on interest for money they borrowed in the past, they have less money to spend now. And so that also diminishes corporate earnings because they can't spend money buying the goods and services of other corporations. And consumers are going to be in the same bind. A lot of individual consumers of corporate goods and services are going to be spending a lot more interest on their own debts or paying the higher price for food, energy, insurance, healthcare, taxes. There's not going to be money left over for discretionary spending, which makes up the lion's share of corporate earnings. And so not only are stocks not cheap despite this big drop, but the earnings are about to fall through the floor, meaning stocks are even more expensive than they appear. So if we had a big down year, and as a result of a big down year, stocks were fairly valued or they were cheap, well, then maybe we'd have a rebound in the following year. But if stocks remain expensive despite a big decline, well, forget about what happened historically. I think it's far more likely that expensive stocks will continue to fall rather than rise, especially when you look at the bigger picture, which is interest rates have just risen sharply and are likely to keep rising. We have a huge inflation problem that we didn't have in other years where we had the big drop and then we had a recovery. The Fed is way behind the curve fighting an inflation problem that is going to get bigger. And it's not just the stock market that's having problems. It's the bond market. In fact, the S&P 500 had the 7th worst year ever. The total return was minus 18.1% when you include the dividends. But the bond market had the worst year ever. 10-year treasuries dropped 16%. There's never been a year where treasury bonds have fallen by 16%. And in fact, if you look at the return on the 60-40 portfolio, it was down 16.9% on the year. That is the third worst year ever for the 60-40 portfolio. And in fact, the only 2 years where investors in a 60-40 portfolio did worse than they did in 2022 was 1931 and 1937. Now, what those 2 years have in common is they fell during the Great Depression. So outside of the Great Depression, we've never had a year where investors have done so poorly on stocks and bonds. But despite the fact that we've had such a big fall in 10-year treasuries, 10-year treasury bonds remain historically expensive. As I am recording this podcast earlier today, the yield on a 10-year treasury closed at 3.8%. That is a very low yield, which means a very high price for treasury bonds, especially when you're looking at 7 or 8% inflation. So we have a 10-year treasury with a real yield of around -4%. And of course, the real yield is actually lower than that if you had an accurate CPI, which we don't. But even using the government's rigged CPI, which dramatically understates the effect inflation has on prices, you still have a -4% real yield on bonds. Bonds are expensive. And so bonds are likely to have another down year in 2023. And if bonds are going to have a down year in 2023, that's going to put a lot of pressure on the stock market to also have a down year in 2023. So all these analysts that are coming out and saying, well, historically, bad years are followed by good years, have no idea what they're talking about because they're not looking at all the other historic precedents that are being broken right now based on the valuations in the stock and bond market and how weak the economy is, how weak earnings are. And in fact, we're likely to start the year in a recession. In fact, I think we were in recession in 2022, but nobody wants to acknowledge that. But just about everybody who is in denial of the 2022 recession expects a recession in 2023. Yet they still expect the stock market to do well, even though we're going to be in recession. Why? Well, first, everybody expects the recession to be very mild and very shallow, and that's where they're wrong. They're right about the recession, but they're wrong about the severity and the depth. But also, one of the reasons that so many people are confident that the recession is going to be short and shallow is because they also expect the Fed to come to the rescue by going back to QE and by reversing the rate hikes with rate cuts. But even if it does that, it's not going to be a good year for U.S. stocks. It may be a good year for some U.S. stocks, but not the broader averages, in particular the NASDAQ, because these tech stocks are going a lot lower, even if the Fed comes to the rescue, because it won't be able to rescue these stocks because inflation is not going to come down. In fact, when it tries to rescue the market, an already high inflation rate is going to move even higher, and that is going to hurt these high multiple tech stocks or these earningless companies, and we're going to continue to see the momentum shifting from those type of momentum stocks into value-oriented dividend-paying stocks. And in fact, if you look at the returns in 2022, I mentioned that the S&P was down 18.1%. The Dow was only down 9%. Why was that? Well, because you have more value-oriented stocks in the Dow. The Russell 2000 down 21%. Why was the Russell 2000 down more than the S&P? Well, because you have fewer value names there than in the S&P. And the index that was down the most was the NASDAQ. It was down 33%. And that's because you have that index dominated by these growth names. And those same growth names are overpriced now. And they're going to continue to fall in an environment of high inflation. And in fact, if you look at the more riskier subset of the NASDAQ, the real risky stocks, like the ones that Cathie Wood owns in the ARK Innovation ETF, that ETF was down 67% in 2022. And it closed the year 80% below its 2021 high. And even though it was down that much, and it was down again today, it was down 2.5% on the first day of trading of 2023. That's why the common stockholders, that's a risky investment when you buy common stock. Now, certain stocks are riskier than others. When you pay a higher PE, you accept a lower dividend yield because more can go wrong. And what makes stocks risky as opposed to bonds is with bonds, you know what the return is going to be. You have no idea what the return on stocks are going to be because you don't know what the company is going to earn. And you don't know what other problems may come up that may cause that company to lose a lot of value. So that is risky. Now, obviously, you could mitigate the risk in the stock market by buying stocks at lower PEs, stocks that don't have a lot of debt, that have long histories of paying dividends, that have been in business for a long time. So not all stocks are equal. Some are a lot riskier than others. But those are risk assets because the return is unknown. You're taking a risk. You're betting that this stock is going to do well, that its earnings are going to grow. But if you're wrong, you could lose. But if you're right, you can make a much better return than just clipping a coupon on a bond.